A company's number one goal is to make money. Not only do the company owners want to have a profit at the end of every accounting period, but they also want the company financial statements to look as good as they can. After all, the financial statements are what potential investors and creditors look at when they make the decision whether or not to lend the company money or to become an investor. This is where the concept of earnings management comes into play. Earnings management, in a nutshell, is the creative use of different accounting techniques to make financial statements look better. Now that doesn't exactly sound like a legal thing to do, does it? But believe it or not, it actually is. This was a very hard concept for me to grasp when I was learning it. How could something that seems so illegal actually be legal? And why would there be the need to dabble on that fine line between legal and illegal? The best way to answer this question is to use the acronym WISE. WISE stands for window dressing, internal targets, income smoothing, external expectations. Window dressing refers to the company's decision to dress up the financial statements for potential investors and creditors. The goal of this is to attract new supporters by having financial statements that look like the company's doing great. The company needs to appear to have a history of being profitable, even if it means lowering profits in one accounting period to increase profits in another. Even though this seems fraudulent, it isn't. Overall, the company is still reporting the same amount of profits, but is spreading them out evenly over a specific time period. Internal targets are another reason that a company may choose to use earnings management techniques. Oftentimes, the company has set its own internal goals, such as departmental budgeting, and wants to be sure to meet those goals. No department wants to be the one to blow the proposed budget, so earnings management techniques are used to balance this out. Income smoothing comes into play here because of the fact that potential investors generally like to invest in companies that have a continuous growth pattern. Smoothing out income generated when there may be spikes at certain times and drops at others allows it to appear like the company has that smooth growth pattern. External expectations comes into play when the company has already made projections as to what their profits will be, and investors now expect that exact amount of profits or more. Management may feel the need to shift revenue from one accounting period to another in order to meet the projected goal. Earnings management, quite simply, takes advantage of the different ways that accounting policies and procedures can be applied to financial reporting. Now that you're familiar with some of the reasons why earnings management occurs, let's look at some of the legal techniques that are used. Though there are a number of these techniques, for this lesson we're only going to look at the top 5. Number 1, the big bath. This technique is often called a one-time event. What happens with the big bath technique is that an out-of-the-ordinary or non-reoccurring event occurs in a company, and expenses associated with that event are actually inflated. So how can they inflate expenses and still be within GAAP guidelines? Easily. The company reports all of its expenses, but instead of attributing them to the correct accounts, they're all attributed to the one-time event. Let me give you an example, and this will help you understand. Billy owns multiple pizza restaurants. After months of struggling, one of the restaurants just has to be closed. This is a one-time event, and not one that's considered common. Since Billy knows that this loss will already cause a decrease in his reported net earnings, he decides to go ahead and charge a majority of the company's expenses to this business unit shutdown. He also knows that he doesn't want investors and creditors to think that the company's faltering, so he decides to count part of the loss in one accounting period and part in another. When the annual financial statements are printed and made available to the public, the bottom line net profit for the company will be correct. Number 2, cookie jar reserves. This technique is also an income smoothing technique. It occurs when expenses are based on estimates. If the company overestimated expenses, then it may choose to use a portion of the expenses in one accounting period and save the other for future accounting periods. Let's go back and look at Billy again. There was an electrical fire at one of Billy's pizza parlors. Billy hires a contractor to totally rewire the building and make sure that everything is up to code in the restaurant. Since all this happened at the end of the accounting period, Billy took the estimate that the contractor gave him and counted that as an expense for the current period. When the actual payment was made to the contractor, it was for much less than the estimate, and it was paid in another accounting period. This caused there to be an overage of expenses claimed in the prior accounting period. When it came time to close the books for this accounting period, Billy sees that he made a bit more money than he actually wants to report. He decides to pull some of those expenses out of the cookie jar and apply them to the current period. Number 3, operating activities. This earnings management technique occurs when managers plan certain events to occur in certain periods. This means that managers may decide to purchase new equipment in a period where income has been reasonably high. They want to ensure that the income is leveled out with prior periods so that there won't be a spike in some months and dramatic decline in others. Even though they're rearranging the timing of the purchase to best benefit the financial reports, they're still accurately reporting the expense. Once again, let's go back to Billy. Billy has had 2 really good months in the pizza business. He knows that his revenue generated is well above what he reported in the last accounting period. He decides that now's the time to purchase the new brick ovens that he wants in the pizza parlors. He purchases $25,000 in new equipment for the restaurants, which increases his expenses for the accounting period and decreases his revenue. Number 4, materiality. This may be the most common form of earnings management for big business. The term materiality refers to the degree that a financial transaction will impact the overall financial statements. Materiality is oftentimes considered a gray area, since what is material for one business may not be material for another. Billy filed an insurance claim on the electrical fire that occurred at the pizza parlor. The insurance company agreed to pay him $26,500 for repairs in the restaurant. The actual cost of the repairs was $28,678. Billy ended up with a loss of $2,178. He can't decide if he should report the extraordinary loss on his financial statements. The net income that Billy has for this period is $89,136. The percentage of the loss is only 2.4%. Because the loss is such a small percentage of net income, reporting the loss would not have any effect on the financial statements, so it's not material in nature. Number 5, revenue recognition. In this earnings management technique, the timing of when revenue is recognized is manipulated. Since the decision of when revenue was earned and expenses incurred can vary based on individual opinion, this earnings management technique, like the others, is legal. However, this is also one that can quickly turn fraudulent if numbers in the next accounting period are drastically affected by the choice to not realize revenue or expenses in the prior period. Management sometimes finds itself trying to constantly cover up the mistake and may cross the line from legal to illegal quickly. Billy knows that sales during the summer are much higher than in the winter. He wants to make sure that he doesn't show a dramatic drop in income from the July, August, and September quarter to the October, November, and December quarter. He decides to push sales at the end of September by offering employees bonuses for increased sales. He knows that the revenue won't be recognized until the next accounting quarter and can cushion the decrease in sales that have historically occurred. Earnings management is the creative use of different accounting techniques to make financial statements look better. This can be a very hard concept to grasp simply because there is a fine line between legal earnings management and fraud. Now, why would someone want to take the chance to even participate in earnings management? That question can be answered in one acronym, WISE. WISE stands for window dressing, internal targets, income smoothing, and external expectations. Window dressing refers to a company dressing up the financial statements to make them look better for financial statement users. Internal targets are drivers of earnings management when a company has set its own internal goals and wants to be sure to meet them. Income smoothing occurs when companies choose to smooth out spikes and dips in income. External expectations occur when management predicts a certain degree of profits for investors and investors now expect it. There are 5 common techniques that are used to manage earnings. The big bath technique occurs when a company has a one-time, non-recurring event happen and expenses associated with that event are inflated. Cookie jar reserves occur when expenses are based on estimates. Operating activities refers to managers planning certain events to occur during certain periods. Materiality refers to the degree that a financial transaction will impact the overall financial statements. Revenue recognition refers to the manipulation of when revenue is recognized. No matter what earnings management technique is used, the bottom line is this: accounting professionals must always follow the guidelines set forth in the law and be careful that any stretches do not break the limits of the law. Have you ever balanced your checkbook? Why'd you do that? Was it to make sure that you didn't make any mistakes when you were adding deposits or subtracting expenses? I bet it was because you wanted to make sure that your balance in your checkbook was the same as the balance in the bank, right? Well, everything that we just talked about refers to what we in accounting commonly call doing a bank reconciliation. A bank reconciliation is the balancing of a company's cash account balance to its bank account balance. Since it's really important to make sure that the cash account and the bank account balances match, a company prepares bank reconciliations on a monthly basis. There are several steps that are involved in this, but even so, it's a relatively simple thing to do. Let's go through the steps and prepare the reconciliation. Step 1. Collect the documents that you'll need to prepare the reconciliation. The most common documents will be the bank statement that's received from the bank and the check register for the month. In the accounting industry, most check registers are printed off of accounting software and used for the reconciliation. The bank statement tells you what the bank balance was at the beginning of the month, the deposits the bank has on record for the account, the withdrawals that have been made from the account, and the ending balance of the account on a specific date. The check register will show all the deposits and withdrawals that were made by the company during a given time period. There's one key difference between the bank statement and the check register. The bank statement only lists deposits and withdrawals that have processed through the bank, while the check register lists all the deposits and withdrawals that a company had in a specific period, regardless of if it has cleared the bank or not. Step 2. The second step in preparing the bank reconciliation is the most tedious. The object of this step is to account for all the deposits and withdrawals that a company has recorded and that have also cleared the bank. If you're manually preparing the reconciliation, you would highlight or check off the entries that are common among the two. In a computerized accounting program, you can simply just click on the entries to mark them as cleared. Cleared means that the item has been recorded in both the company's records and the bank records. Step 3. Once you have marked the items that are cleared on the check register, you move to the next step. In this step, you'll make a list of any items that have been recorded in the check register but have not cleared the bank. Typically, a company will always have outstanding debits in the month. Outstanding debits are checks and other withdrawals that have been recorded in the company's cash account but have not yet been recorded in the bank's accounting records. There may also be outstanding credits that need to be accounted for. Outstanding credits are deposits that have been recorded in the company's records but don't yet appear on the bank records. Step 4. Now that you have all the outstanding debits and outstanding credits together, it's time to do the math. Any debits that haven't been accounted for will need to be deducted from the balance on the bank statement. Likewise, any credits that haven't been accounted for will be added to the balance on the bank statement. In a perfect world, once this step is complete, the current balance in the checkbook would match the adjusted bank statement balance. Step 5. Notice that I just said in a perfect world the balances would match. It's not always a perfect world. Sometimes the balances don't match. That's when your detective skills come into play. If the current balance in the checkbook does not match the adjusted bank statement balance, then you have to start looking for errors. The most common error that occurs and is discovered on the reconciliation process is called transposition. Transposition occurs when the order of numbers are inadvertently switched during the recording process. For example, let's say that a check was written for $412 to pay a utility bill, but was recorded in the checkbook as $421. That error would cause a $9 difference between the two balances. Of course, there could be other errors that cause the balances not to equal. Either a check or a deposit may not have been recorded, or something may have been recorded twice. These are things that can be found and fixed in the reconciliation process. Now that we've looked at how to prepare a reconciliation, the purpose of the reconciliation should be quite obvious. The purpose is to ensure that the balance in the company's cash account matches that in the company's bank account after all necessary adjustments have been made to each. This ensures that any errors in either account are detected and gives an added sense of comfort in the reliability and accuracy of accounting records. A bank reconciliation is the balancing of a company's cash account balance to its bank account balance. In order to prepare the reconciliation, there are 5 basic steps to follow. First, all necessary documents need to be gathered. The 2 primary documents are the bank statement and the check register. The bank statement tells you what the bank balance was at the beginning of the month, the deposits that the bank has on record for the account, the withdrawals that have been made from the account, and the ending balance of the account on a specific date. The check register shows all the deposits and withdrawals that were made by the company during a given time period. The second step is to note what items on the check register have cleared the bank. Cleared means that the item has been recorded in both the company's records and the bank's records. After all the cleared items have been noted, then it's time to address the uncleared items. Uncleared items are either outstanding debits, which are checks or withdrawals that have been recorded in the cash account but have not yet been recorded in the bank account, or outstanding credits, which are deposits that have been recorded in the cash account but not the bank account. Outstanding debits are subtracted from the bank balance, while outstanding credits are added to the balance. Once this step is complete, the cash account balance that shows in the check register should match the adjusted bank account balance. If not, then you have to look for errors and correct them. The most common error is transposition, which is where the order of numbers is switched in the recording process. Other common errors are failure to record withdrawals and deposits, or double recording of deposits and withdrawals. Whatever the case may be, once the bank reconciliation is complete, then you can be confident in the accuracy of the account balances.
In accounting, an account records every transactional increase and decrease to the balance of that account. For example, the accounts payable account contains all transactions increasing or decreasing accounts payable. The general ledger is the record of all accounts used by the company. It's the main accounting record of the company, containing and recording every accounting transaction. The general ledger is also commonly referred to as the ledger, or more informally, the books of the company. General ledger reconciliation is an internal control procedure that helps ensure account balances in the general ledger are materially correct. This process must be carried out in a timely and consistent manner at the same time each month for optimal efficiency. As part of the internal control system of a company, there should be a written general ledger reconciliation policy to ensure this process is performed monthly for all balance sheet accounts of the company. A common form of general ledger reconciliation occurs when a subsidiary ledger is reconciled to the general ledger balance. A subsidiary ledger contains detailed information on a specific account. 2 of the most common subsidiary ledgers are the accounts receivable and the accounts payable ledgers. The accounts receivable ledger stores accounting data for each individual customer. The accounts payable ledger contains data for each vendor. Different companies use several types of ledgers. One example is a company in a capital-intensive industry will use an equipment subsidiary ledger to record the extensive list of equipment it owns. The general ledger reconciliation process partially requires the balance of the subsidiary account agree with the corresponding balance in the general ledger. Any discrepancy needs to be investigated. Sometimes, general ledger accounts will not have a subsidiary ledger to reconcile to. The cash account is the prime example of this. In this case, the cash balance in the general ledger will be reconciled to the monthly bank statement. This process is becoming increasingly automated, so bank reconciliations will not be discussed here. Occasionally, general ledger account balances must be reconciled to an outside statement. For instance, a general ledger rent deposit account must be reconciled to the bank statement to account for any interest the deposit has been accruing. The following guidelines are a common example of how a general ledger reconciliation is performed. Understand any accounting policies for the account you're about to analyze. Knowing what transactions belong in the account will be extremely helpful as you proceed. For example, if you are reconciling the accumulated depreciation accounts, you will need to understand the depreciation policies of the company. Gather supporting documentation for the account. If you are reconciling the bank account to the general ledger, you will need such things as the bank statement, canceled checks, and other supporting documentation. If you are reconciling accounts receivable, you will need the accounts receivable ledger. Review the account. Are the transactions in the account properly recorded according to generally accepted accounting principles and the company policy? Are there any unusual transactions that you see, either because of the amount of the transaction or the nature of the transaction? For instance, a large cash withdrawal recorded in the petty cash account should be investigated immediately. Make sure the general ledger balance agrees with the supporting documentation. Investigate any discrepancies and process any journal entries needed to ensure the two are in balance. Document your work and obtain the necessary approval. The documentation not only demonstrates compliance with internal control policy and procedure, but provides a roadmap for work in subsequent months. You're required to perform a reconciliation of the accounts receivable subsidiary ledger to the general ledger at month's end. After obtaining the required documents and reviewing them, you do not notice any unusual items. Then you reconcile the subsidiary ledger total to the general ledger balance, which you can see here. After investigating, you find there were 2 journal entries made directly to the general ledger account. The first journal entry is this one appearing here. An FOB destination shipment can only be recorded when the goods were delivered to the customer. In this case, a shipment was made by truck to a customer several states away. The shipment couldn't have arrived in time, so this appears to be a valid adjustment. The second entry is, travel and entertainment expense is paid by company check, so you alert the person responsible for bank reconciliations. This will be an adjusting entry for him, and you propose the following correcting entry that's appearing here. Your final accounts receivable reconciliation will be the balances appearing here, which we can see totals out at $985,000. After the correcting journal entry has been made, accounts receivable now stands at its proper balance. Reconciliations should be performed for all balance sheet accounts and selected income statement accounts as necessary at the month's end. All right, let's take a moment to review what we've learned. In this lesson, we learned about how to reconcile the general ledger, which is the record of all accounts used by the company. The general ledger reconciliation, though, is an internal control procedure that helps ensure account balances in the general ledger are materially correct. And this process is a critical internal control. Each general ledger balance sheet account must be reconciled to the supporting detail at the end of each month. This supporting detail may be a subsidiary ledger, which contains detailed information on a specific account, or other documentation, such as a bank statement. The reconciliation needs to be documented and approved.
Financial data consists of pieces or sets of information related to the financial health of a business. The pieces of data are used by internal management to analyze business performance and determine whether tactics and strategies must be altered. People and organizations outside of business will also use financial data reported by the business to judge its creditworthiness, decide whether to invest in the business, and determine whether the business is complying with government regulations. Let's look at some of the key types of financial data that are of the most importance to internal management and outside stakeholders. Assets include everything that a business owns and includes all personal property, real property, and intangible property. Real property is real estate and anything that is attached to it. Personal property is any property that is not real property. Tangible property is any physical property such as equipment, furniture, tools, or inventory. Intangible property is non-physical property such as a patent or goodwill. The total value of a company's assets is reported on the company's balance sheet. Liabilities are the financial obligations of a company, such as what the company owes to others. Liabilities can include such things as debt, which is money owed to a lender along with any interest. Liabilities can also include accounts payable, which is money owed to suppliers for goods and services bought by the company. They also include other obligations such as wages, benefits, and taxes. Liabilities can be short-term, which means the obligation will come due within a year, or long-term, where the liability will come due in a year or longer. Liabilities are reported on the company's balance sheet. Equity is the value of the company left over after the company has paid all of its liabilities out of all of its assets. Equity belongs to the owners of the company. Sometimes, however, there is no equity because the value of the liabilities exceed the value of the assets. Important data related to equity includes the number of outstanding shares in the classes of shares. A share is a unit of ownership. Sometimes there are different types of ownership interests. Common stock, for example, is an ownership unit that has the right to vote. Preferred stock, on the other hand, generally do not have voting rights, but do often have the right to receive dividends or income distributions. Before common stock and often are entitled to have equity paid back before common stockholders if the company is liquidated. Income represents any increase of wealth generated by business activities. Income can be generated by sales revenue or by investments. An example of investment income is income earned by a stock portfolio kept by a company or the interest earned on its money market account kept for payment of current expenses. If income exceeds expenses, then the company is enjoying a profit, but if expenses exceed income, the company is suffering a loss. The income a company generates during a specific period of time is reported on the company's income statement. Expenses are a type of liability. They represent the cost of doing business and are usually paid for by the use of the company's income, or are financed through debt. If expenses exceed income, the company is suffering a loss. Otherwise, the company is profitable. Like income, expenses are reported on a company's income statement. Cash flow tells you where a company's money is coming from and where it is going. It helps you determine how well the company manages its finances. Cash flow is reported on a company's cash flow statement. Financial data is information about a company that tells you about its financial health and performance. It's used by both internal management as well as outside stakeholders, such as investors and government regulators. Important forms of financial data include assets, liabilities, equity, income, expenses, and cash flow. Assets are what the company owns. Liabilities are what the company owes, and equity is what is left for the owners of the company after the value of the liabilities are subtracted from the value of the assets. Income is what the company earns, while expenses are what the company expends to operate. If income is greater than expenses, then the company has a profit. If not, it has a loss. Cash flow tells you where the company's money comes from and where it goes. It helps you determine how good the company is at managing its finances.
Financial reporting involves the disclosure of financial information to management and the public, if the company is publicly traded, about how the company is performing over a specific period of time. Financial reports are usually issued on a quarterly and annual basis. This is different from management reporting, which is financial information that is disclosed to those inside the company to be used to make decisions within the company. Financial reports are included in a public company's annual report. Financial reporting serves two primary purposes. First, it helps management to engage in effective decision-making concerning the company's objectives and overall strategies. The data disclosed in the reports can help management discern the strengths and weaknesses of the company, as well as its overall financial health. Second, financial reporting provides vital information about the financial health and activities of the company to its stakeholders, including its shareholders, potential investors, consumers, and government regulators. It's a means of ensuring that the company is being run appropriately. You should note that if a company is publicly traded, it is subject to some very strict reporting regulations enforced by the Securities and Exchange Commission, SEC. Let's take a look at the primary financial statements used in financial reporting and what each will tell you about the company. A balance sheet is a snapshot of what the company owns and how it financed what it owns through borrowing or through the company's owner's investments. Now let's look at it in a more technical sense. A balance sheet is based on the standard accounting model. Assets equal liabilities plus equity. The balance sheet breaks down these components and reports the company's assets, liabilities, and equity. Assets are the things that a company owns or is owed, including cash. Liabilities are what the company owes to other companies or to individuals. Equity is the amount that the owners, including shareholders if applicable, have invested, plus retained earnings or losses. These are the earnings or losses that have accumulated since the company was started that were not paid out as dividends, which means they were reinvested into the company. Also known as a profit and loss statement, P&L, an income statement reports on the company's earnings over the reporting period. It will tell you the amount of revenue the company generated, what it cost to earn that revenue, and the general expenses incurred to operate the business. If revenue is greater than expenses, then the income statement will reflect a net profit for the reporting period. If expenses exceeded revenue, then the company suffered a net loss for the period. The cash flow statement reports on all the dollars that come into the company and go out of the company during the reporting period. More specifically, it will tell you where your money came from and where it went, categorized by operations, investments, and financing. It helps you figure out if the company is doing a good job managing its money. A cash flow statement is also known as a statement of cash receipts and disbursements. The company may also report on changes to its stockholder equity. This report gives you the details on the equity section of the balance sheet. It will tell you how many shares are outstanding, the change in share price from the last reporting period, and the amount of retained earnings. Financial reporting is the process of disclosing certain financial information to people inside and outside a company. Financial reporting consists of 4 primary documents. The balance sheet lists the company's assets, liabilities, and equity. It tells you what the company owns, what it owes, and how much the owners have invested in the company. The income statement discloses what the company earned and what it spent to earn it. It will tell you if the company earned a net profit or suffered a net loss. The cash flow statement tells you where the company's money came from and where it went. It helps you determine how well management is controlling the company's money. Finally, the change in stockholders' equity may be reported. This will give you the details on the equity section of the balance sheet.
This video provides a short introduction to suspense accounts.
A control account is an account within the general ledger, or GL, that sums up balances in subsidiary accounts. A general ledger can hold hundreds, sometimes thousands of accounts and sub-accounts. Trying to include all of these in the general ledger can make it unworkable, so a control account is used. As we'll see later on in this lesson, the control account is also a useful reconciliation tool between the detailed sales and purchases data and the totals eventually posted to the GL. Let's say that you run a medium-sized business. At any given time, you've extended credit to 2,500 clients. The people that owe you money are called debtors. With such a large number of debtors, it would clutter the general ledger with 2,500 single accounts. In order to simplify the mess, you can create both a control account and subsidiary ledger for your debtors. We'll look more closely at the subsidiary ledger later in this lesson. The debtor's control account is an account in the GL that shows the total of all transactions with debtors. Entries must still be made using the double entry method, credit or debit, but the following totals are entered: the sales journal totals, or the total amount of credit extended, and the total amount that debtors have paid to the company. Not only could you have multiple debtor accounts, but you might also have a large number of accounts payable entries. Like the debtor's control account, it shows bank account balances and total purchases. Let's put both together, which you can see in these tables appearing here on your screen. First, we have the debtor's control account, and then we have the creditor's control account. The stock control account, which summarizes transactions related to inventory and stock, follows the same principle as the debtor's and creditor's control accounts. We don't need to list every single item from our inventory in the GL. Instead, we create a stock control account. You still need to have journal entries for stock transactions, buy or sell or return, but can make use of the control totals in the GL. Just because you summarize all debtors and creditors does not mean you don't have to log each entry for each entity. The transactions and entries still have to be logged in another ledger. This subset of data is a ledger in its own right. Remember when we referred to control accounts and a subsidiary ledger? The The subsidiary ledger holds an account for each debtor and creditor. Take a look at the sample appearing here. The previous totals would come from an accounting journal like this. We should also have a creditor's subsidiary ledger, like the debtor's ledger we just showed. After all, the control account isn't intended to avoid logging all entries. It's meant to clean up the GL and to provide another reconciliation tool. Recall that our total sales entered into the debtor's control account was $32,500. This matches the journal entry for the individual sales. If they hadn't balanced, there would be a problem. However, the control account helps us really get our numbers in order and assure that everything balances. Not only do control accounts free up clutter in the general ledger, they help reconcile the books. Let's say you totaled up the debtor's accounts and compared it to the closing balance from the previous period. If this total does not match the total from the individual debtor accounts, then you know there's an error that needs to be fixed. Before reporting an erroneous value, you can go back and fix the problem. All right, let's take a moment to review what we've learned. Instead of including every single account and sub-account in the general ledger, accountants can use a control account. This account summarizes and combines subsidiary accounts of a given type. Common types include the creditor's control accounts and debtor's control accounts, which summarize the payments due from debtors. You can also use a stock control account to summarize transactions related to inventory and stock. You still need to capture the details. These are part of a subsidiary ledger, which holds an account for each debtor and creditor. It's important to remember that all values must reconcile.
Have you ever noticed that no matter what you do in life, it involves a process? Think about it. You don't get out of bed in the mornings dressed and ready for work. You have to follow certain steps to get to that point. Well, accounting is the same way. Financial statements aren't immediately prepared as soon as accounting books are opened. It takes a series of steps to get to that point. One of those steps involves something called an adjusted trial balance. The adjusted trial balance is a report that lists all the accounts of a company and their balances after adjustments have been made. I know, the concept can be a little confusing, so let's dive a little deeper into it and figure it all out. Okay, so you know the textbook definition of the adjusted trial balance, but what is it in layman's terms, and how do you create one? Well, let me start by taking a step back in the accounting process and talking about the trial balance. The trial balance is a listing of a company's accounts and their balances after all the transactions of an accounting period have been recorded. Some of the company's accounts will need to have an adjusting entry made. Adjusting entries are journal entries that are made on the last day of the accounting period that brings the balances of specific accounts up to date and makes sure that all account balances conform to the principles of the accrual basis accounting method. The accrual basis accounting method is the method of accounting that recognizes revenue when it is earned and expenses when they are incurred, regardless of when cash is received or paid out. Before any adjusting entries are made, accountants will prepare a multiple column worksheet. This worksheet allows the person preparing journal entries to pencil in the needed adjustments and make sure that the total of all debit and credit balances still add up after adjustments have been made. The best way to explain how to prepare an adjusted trial balance is to just walk you through one. Jimmy is the comptroller of a small manufacturing firm. It's time for him to begin getting information ready to prepare his company's quarterly financial statements. Jimmy knows that all the transactions for the quarter have been journalized and posted, so he can create his trial balance report and start working on the worksheet for any adjustments. The first two columns are the account balances of the company after all transactions have been posted. These numbers come directly from the balance that appears in the general ledger. The second two columns show the adjustments that have been made to a few accounts. Let's take a little time to look at the adjusted account. The first thing that Jimmy does is to look at the supplies account. He knows that for this accounting period the company used supplies. To make sure that he accounts for that and reflects the correct balance on the financial statements, he'll have to adjust the supplies account with a credit of $18,480 and the supplies expense account with a debit of $18,480. The end result is a decrease in the supplies account and an increase in the supplies expense account balances. This takes care of the cost of supplies used by the company during this accounting period. The second account that needs attention is the prepaid rent account. At the beginning of the year, the company paid 6 months' rent on a storage warehouse that they use. Since the company produces quarterly financial statements, the time accounted for in each accounting period is 3 months. Jimmy knows that of the 6 months prepaid rent, the company has used up 3 months, or half of the prepayment. To account for this, he has to make an adjustment to the prepaid rent and the rent expense account. He credits prepaid rent in the amount of $12,000, which is half of the prepayment, and debits the rent expense account in the same amount. Again, the balances in the two accounts will change as a result of the adjustment. If you notice, an adjustment is really just a transfer of a specific calculated dollar amount from one account to another account. This is the most important part and the specific reason that the adjusted trial balance worksheet is completed. When Jimmy's finished, he calculates the new balances of the accounts and enters them in the last 2 columns on the worksheet. He's now ready to use this information to help create the financial statements. The main goal of the accounting process is to create accurate financial statements. In order to reach this goal, there are a number of steps that must be completed. One of those steps is to create an adjusted trial balance. An adjusted trial balance is a report that lists all the accounts of a company and their balances after adjustments have been made. The adjusted trial balance is created on a multi-column worksheet. The first 2 columns of the worksheet contain information from the trial balance. The trial balance is a listing of a company's accounts and their balances after all transactions of an accounting period have been recorded. Now, some of the company accounts will not adequately reflect their true balance at the time, and adjustments will need to be made. These adjustments, called adjusting entries, are journal entries that are made on the last day of the accounting period that brings the balances of specific accounts up to date and makes sure that all account balances conform to the principles of the accrual basis accounting method. The accrual basis accounting method is the method of accounting that recognizes revenue when it is earned and expenses when they are incurred, regardless of when cash is received or paid out. Adjustments are entered into the middle 2 columns of the worksheet. Once adjustments have been entered, the account balances are recalculated and the final and most accurate balances are entered into the last 2 columns of the worksheet. When the adjusted trial balance is complete, you're one step closer to reaching the goal of creating a company's financial statements.
Profitability is the ability of a business to earn a profit. A profit is what is left of the revenue a business generates after it pays all expenses directly related to the generation of the revenue, such as producing a product and other expenses related to the conduct of business activities. There are many different ways for you to analyze profitability. This lesson will focus on profitability ratios, which are a measure of the business's ability to generate revenue compared to the amount of expenses it incurs. Let's look at a few of the primary analytical approaches. Net profit margin measures the profitability of your business. The formula is net profit margin equals net income divided by net sales times 100. Let's say you have net income of $100,000 and net sales of $1 million. What is your net profit margin? Well, we know net profit margin equals net income divided by net sales times 100. So, net profit margin must equal $100,000 divided by $1 million times 100. 100,000 divided by 1 million equals 0.1. The net profit margin equals 0.1 times 100. So, the net profit margin in this example is equal to 10%. This means that for every dollar you make in sales, you earn a dime in net income. Gross profit margin measures the cost of production. The formula is gross profit margin equals gross profit divided by net sales times 100. Let's say you have a gross profit of $125,000 and a net sales of $3,750,000. What is your gross margin? Gross profit margin equals gross profit divided by net sales times 100. So in this example, gross profit margin equals $125,000 divided by $3,750,000 times 100. Therefore, the gross profit margin equals 0.03 times 100. 0.03 times 100. Gross profit margin equals 3%. Operating margin tells you how much costs unrelated to producing the product for sale are cutting into your profits. Costs unrelated to production can include such things as general business, staff, and administrative expenses of the business. Net operating margin is often referred to as your earnings before interest and taxes, or EBIT. The formula for this is operating margin equals operating profit divided by net sales times 100. Let's take a look at an example. You have an operating profit of $90,000 and net sales of $1 million. What is your operating margin? Well, we know that operating margin equals operating profit divided by net sales times 100, so operating margin will equal $90,000 divided by $1 million times 100. Operating margin equals 0.09 times 100, 0.09 times 100. The operating margin equals 9%. This tells you that you earn 9 cents out of every dollar you make in sales for business expenses not related to production. Your return on assets, or ROA, measures how effectively and efficiently you are using your business assets to generate profit. The formula for ROA is return on assets equals net income divided by total assets times 100. Let's say your business has assets of $5 million and generates a net profit of $750,000. What is your return on assets? Since return on assets equals net income divided by total assets times 100, use this ratio with the given numbers. Return on assets equals $750,000 divided by $5 million times 100. $750,000 divided by $5 million, therefore return on assets equals 0.15 times 100. Your return on assets would equal 15%. A ROA of 15% means that your company generates 15 cents in profits for each dollar it has in assets. ROA is a useful means of comparing your performance against the performance of similar businesses. Return on equity, or ROE, measures the net profit per dollar that owners of a business receive. The formula looks like this. Return on equity equals net income divided by common shareholder equity times 100. Let's say that your corporation has total shareholder equity of $100 million and net income of $18 million. What is the ROE? Return on equity equals net income divided by common shareholder equity times 100. So for this example, ROE equals $18 million divided by $100 million times 100. $18 million divided by $100 million equals 0.18. So return on equity equals 0.18 times 100. Return on equity equals 18%. You earn 18 cents of profit from each dollar invested. Profitability is the ability for a business to earn profit. A profit is simply the revenue left over after you have paid all the costs and expenses related to your business activities. Profitability ratios are a series of metrics that you can use to measure the relative profitability of a business. Common profitability ratios include net profit margin, gross profit margin, operating margin, return on assets, and return on equity.
I love to cook. Every weekend you can find me in the kitchen with my cookbook open, whipping up new and exciting meals. I follow the recipes most of the time, but sometimes I think that there are changes that just need to be made. For example, my recipe may tell me to mix a cake for 3 minutes. However, I think that the batter looks good and smooth after 2 minutes, so I quit mixing. I still expect my final product to look just like the picture in the recipe. And let me tell you, that doesn't always happen. But that reminds me of the concepts that we're going to discuss today, limitations on internal controls. First of all, let's start with defining what exactly internal controls are. Internal controls are procedures that are put in place within an organization to ensure business is carried out in an orderly, effective, and accurate manner. And most of the time, these procedures are put into writing so that everyone can clearly see what the internal control protocols are. However, even with the best of plans, there are limitations on internal control. One major factor that is an important part of an internal control system is the human element. Along with that component comes human error. Human error is an undesirable outcome that is the result of a decision made by an individual. There are two types of human error, intentional and unintentional. Intentional human error is human error that is the result of planned actions. Unintentional human error is human error that is the result of honest mistakes and are not planned actions. For example, let's say that you and I work in a plant nursery. Part of the internal control guidelines states that the windows in the greenhouse must be cleaned daily so that the plants can get the correct amount of sunlight. Now, you may choose to use old newspaper and a vinegar and water-based spray, while I may choose to use regular store-bought cleaner and paper towels. We both cleaned the windows, but we didn't do it in the same way. Now here's where we get to talk about the human error part. Your choice to use a simple homemade solution for window cleaning left the windows clean and shiny, but when I washed the windows, they had a filmy look. The film left on the windows kept the plants from getting all the sunlight they needed, and they started turning brown. This is not at all what the internal control protocols called for. As a matter of fact, it's what they were trying to keep from happening. I didn't purposefully leave a film on the windows, but my interpretation of the way the windows should be washed did end up causing damage to the plants. This was an unintentional error. Now what if I had deliberately planned to use a cleaner that I knew would leave the film on the windows? If that was the case, then the type of error goes from unintentional to intentional. As you can see from this example, unintentional errors are oftentimes the direct result of how internal control guidelines are interpreted by each individual. Now let's look at another type of limitation that exists for internal controls. It revolves around a concept called the cost-benefit principle. In a nutshell, the cost-benefit principle in relation to internal control means that the cost of implementing a certain internal control procedure must not outweigh the benefit that the company receives from the procedure. Look back at the nursery example from above. Since I cleaned the windows of the greenhouses and left a filmy covering on them, I caused the company to lose several plants due to lack of 100% light saturation. In an attempt to keep this from happening again, the owner of the nursery, Mr. Treewillow, decides to hire a professional window cleaning crew to come in and clean the windows every day. He figures that by adding this internal control procedure, it will help eliminate the loss of plants in the greenhouses. The cost of this service is $500 a week. In a year, that will cost a total of $26,000. If the plants that are being started in the greenhouses end up bringing in an average of $25,000 per year, does it make sense for Mr. Treewillow to hire the professional crew? Absolutely not. A better idea would be for him to rewrite the specific window washing guideline and specify what cleaners to be used and the manner in which the windows should be cleaned. This is a more cost-effective way to attempt to ensure that the plants are getting the light they need to grow. Internal controls are procedures that are put into place within an organization to ensure business is carried out in an orderly, effective, and accurate manner. No matter how well a business owner thinks that the internal controls in place in his business are effective, there are always limitations to what they can do. Two specific limitations are human error and the cost-benefit principle. Human error, which is simply defined as an undesirable outcome that is the result of a decision made by an individual, comes in two forms, intentional and unintentional. Intentional human error is human error that is the result of planned actions. Unintentional human error is human error that is the result of honest mistakes and are not planned actions. The cost-benefit principle refers to the idea that the cost of implementing a certain internal control procedure must not outweigh the benefit that the company receives from that procedure. If the cost does outweigh the benefit, then there's no point in implementing that internal control procedure. There's no doubt that internal controls are significant, necessary, and important parts of a business. Even so, you must always keep in mind that no matter how well designed an internal control system may be, there will always be limitations on how well that system performs. I love working with numbers. One of my all-time favorite things to do in the bookkeeping and accounting arena is payroll and payroll taxes. When I first started doing payroll, it was much more time-consuming. I had to manually calculate every dollar earned and every deduction that was made to get the right dollar amount for an employee paycheck. Then computerized accounting entered my world, and payroll was a breeze. I owe the simplification of my job to technology. What do I mean when I say technology? There are a couple of different definitions of the term, but for this lesson, the most appropriate would be that technology is the equipment that is created by the use of scientific knowledge that aids in streamlining business operations. Now, before we get too deep into the discussion on how technology impacts internal controls, let's define exactly what internal controls are. Internal controls in accounting are procedures that are put in place within an organization to ensure business is carried out in an orderly, effective, and accurate manner. These guidelines are used to create job descriptions, separate job duties, and measure company performance. When it comes to internal controls, there are a couple of key areas that have been improved by the use of technology. One of those is improved processing time. In years gone by, when everything was handwritten, it took quite a bit of time to process transactions. Now, one simple scan or even a few keystrokes and an entire transaction is documented. Just think about my payroll responsibilities. It used to take me hours to get all the calculations I needed to make done, checked and double-checked, but now I can get payroll entered into my computer and completely finished in an hour. Now, that's what I call major improvement, and I owe it all to technology. Going hand in hand with reduced processing time comes reduced errors. Have you ever been working on a computer and an error message pops up on the screen? Or what about writing a paper and you get the red or blue lines underneath some words? I can't tell you the times that's happened to me. But that extra level of protection that's built into computer programs really helps to reduce errors. It's through the use of technology that computer programs are created and designed to catch improper inputs into the system. Another way that technology has improved internal controls comes in the form of reduced paperwork. Since the days of handwritten records left us with the coming of age of computers, documents are scanned, sorted, and even written on computers and stored safely on portable devices that fit in the palm of your hand. This allows for years of information to be available in the click of a mouse, making it significantly easier to compare how internal control systems are working. Along with that, you have the internet and computer networking that allows you to email files from one individual to another without having to transport loads of documents. As for me, the reduction of paperwork is a blessing. I no longer have to worry about keeping up with time cards, copies of payroll stubs, or any miscellaneous paperwork associated with my job. Employees punch in via a computerized clock that sends the punches straight to my payroll software on my computer. Now, of course, I have to double check all the information, but that only takes a matter of minutes. I make sure that I back up all my data on a daily basis to a portable thumb drive that's kept in a separate location. If my computer crashes, I still have every bit of information for my accounting duties on my portable device. Now, how is that for technological impact? A crucial component of any internal control system is the separation of duties. Separation of duties means to break down one big job into smaller parts, each performed by a different individual. Doing this creates a valid system of checks and balances. Technology has made it easier to separate job duties while still monitoring job performance. For example, my accounting office has specialized departments. There's an accounts receivable department, an accounts payable department, a payroll department, and a financial analysis department. We all use the same computer program that's networked to all the computers. However, each department enters different information. In the end, it all comes together as a whole and completes the accounting job. Technology in the business sense is the equipment that is created by the use of scientific knowledge that aids in streamlining business operations. It has a major impact on the internal controls that a business has in place. Internal controls are procedures that are put in place within an organization to ensure business is carried out in an orderly, effective, and accurate manner. There are 4 key areas of internal control that are affected by technology. The first is improved processing time. The days when it took a good bit of time to handwrite and process transactions were virtually eliminated with the creation of cash registers and computers. The second is reduced errors. Many computer programs are designed to catch entry errors and informing the user of these errors. A third way that technology has impacted internal controls is by means of reduced paperwork. The ability to scan, sort, compose, and save documents on a portable drive allows for easier transfer of files and gives the business the ability to store several years of documentation in one place. The last and possibly most important way that technology affects internal controls is in the area of separation of duties. Separation of duties means to break down one big job into smaller parts, each performed by a different individual. Technological advances has made it possible to design machinery and programs that work specifically to create individual pieces of the puzzle so that when the work is done, the pieces fit together to make a completed job. As technology continues to move forward and evolve, it will continue to impact not only internal controls, but also every other aspect of the business world. Audit. Just the sound of the word makes many people cringe. The first thing that comes to mind when I heard the word is tax audits. I just can't picture an auditor coming to look through every nook and cranny that I have, looking for something that I failed to report on my taxes. The reality of that is that audits are actually a good thing, and auditors aren't crotchety old people that resemble Scrooge. An auditor, for the purpose of accounting, is a person whose job it is to make sure that information reported on financial statements is true and accurate, and that the financial statements are prepared according to GAAP principles. GAAP, which is short for Generally Accepted Accounting Principles, are the guidelines for financial reporting that accounting professionals must follow. Hard to believe, but the most important thing that an auditor does is to form an opinion. Anybody can do that, right? Well, maybe so, but an auditor's opinion is not just any old opinion. His opinion makes or breaks the reliability of financial statement information. You see, GAAP protocol on financial reporting requires that an auditor's opinion be a part of notes to the financial statements. Notes to the financial statements are footnotes that appear at the bottom of the reports that give financial statement users added details about items that appear on the statements. The general assumption for the purpose of financial statement auditing is that the auditor will form his own independent opinion based solely on the information collected in the audit. If the auditor's opinion doesn't appear on the financial statements, then they don't meet the set standards. Audited financial statements that contain the concise written opinion of an independent auditor are deemed to be true, valid, and reliable. Now that you know what auditors are and what they do, let's talk about the audit process in accounting. This type of audit is called a financial audit. A financial audit is an audit that examines the financial records of a company. There are 6 basic steps that must be completed when performing a financial audit. The first thing that an auditor would do is to look at the way that financial information is given to the accounting department from other departments. Auditors look for timelines in getting documents such as receipts, invoices, bank statements, and payment record from each individual department to the accounting department. The timeline of this activity can and will affect when revenue and expenses are recognized. Meet Jesse. Jesse is an auditor and has been asked to audit Wasabi International. In order to begin the audit, he has to gather certain information. Jesse asked Emma, a clerk in the accounting department of Wasabi International, to show him the company's protocol for transferring financial data to the accounting department. Emma brings Jesse the Policies and Procedures Manual for Wasabi International and shows him the section requiring that any receipts, invoices, bank statements, and payment activity information be handed directly to the accounting clerk by department heads. The second thing that an auditor would do for a financial audit is to look at the company policy on record keeping. Does the company keep things like deposit slips, credit card receipts, sales invoices, and copies of bills for an appropriate time period? The recommendation is to keep all documents that are related to a specific accounting period for at least the duration of the period. Jesse notes that the manual says that all accounting information will be kept for a minimum of 1 calendar year in the office of the company accountant, and then transferred to the company warehouse to be kept for an additional 6-year period. The third thing that would be done by an auditor would be to look at each component of the accounting system that the company uses. Specifically, the auditor is looking for the debits and credits to each account as transactions are entered during the accounting period. In other words, as Jesse will make sure that when a bill is paid by the company, the balance in the expense account increases and the balance in the cash account decreases. The next step for Jesse would be to look into the system of internal controls that the company has. He wants to see if there's a separation of duties in the accounting department, as well as looking at the types of accounting system that's used. For example, the accounting clerk enters all bills in the computer. The accountant processes the bills for payment and prints the checks. The company owner assigns all checks before they're mailed. The goal of this step is to review tracking methods within the accounting department. The fifth step in the financial auditing process is to review the company's cash account. At this point, Jesse's looking to compare such things as purchase invoices to purchase receipts and sales invoices to sales receipts. He wants to match every entry in the cash ledger to either a sale, a bill payment, a payroll check, a receipt, or an invoice. He wants to be sure that information recorded is backed up by a paper trail. The final step that Jesse will take is to review the company's tax records. The purpose of this is to verify that not only the income reported on the company's taxes is the same as the accounting records, but also that the expenses are the same. Once these steps are complete, then Jesse can issue a report either validating the data reported on the financial statements or bringing to light discrepancies. Financial audits, which examines the financial records of a company, are a necessary component of the accounting industry. The audit is performed by an auditor, who is a person whose job it is to make sure that information reported on the financial statements is true and accurate, and that the financial statements are prepared according to GAAP principles. The GAAP, or Generally Accepted Accounting Principles, are the guidelines for financial reporting that accounting professionals must follow. Auditors are charged with the task of forming opinions about the validity of information that is found on the financial statements. It's assumed that the auditor forms his opinion independently based on the information he collected and reviewed during the audit process. There are 6 steps that the auditor will take to complete the audit. First, he looks at how financial information is given to the accounting department. Is it timely or is it not? Next, he looks at the company's policy on record holding. Does it keep things like receipts and invoices at least for the duration of the accounting period? The third step involves examining each transaction that occurred in the accounting period. Next, the auditor examines the internal control system that's in place in the company. Fifth, the auditor looks at the company's cash account and examines any activity that has occurred here. The last thing that the auditor does in the audit process is to carefully review the company's tax records. Once this is done, then users of financial statements can be confident that the statements are accurate and truthful. Do you have any idea what accounts receivable are? You may already have an idea of what they are, but just allow me to take a few minutes to teach you exactly what they are, how they come about, and how they're recorded in the accounting records of a company. Accounts receivables, which are oftentimes simply called AR, are the money that is owed to the company by customers for goods or services rendered. It's a simple turn of events that creates an accounts receivable. In order to have an accounts receivable, you need 2 things, a sale and a purchase. A company sells an item or service to a buyer and extends credit to that buyer so that the total cost of the sale can be paid later and on terms that are agreed upon by the seller and the buyer. When the buyer agrees to the terms set forth by the seller, then a purchase has been made. Now, if that extension of credit is not given and payment is rendered at the time of sale, then no accounts receivable was created. Once the accounts receivable is created, it has to be recorded in the accounting records. Since the AR account is considered an asset account, it's recorded in the ledger and reported on the balance sheet of a company. Well, that's a lot of terms there, isn't it? Well, let me explain them just a little bit better. An asset is something that a company owns. The ledger is the place where all the increases and decreases in balance sheet accounts are recorded. The balance sheet is the financial statement that reports all the accounts of a company and their balances. Now that clarifies things, doesn't it? Let's talk about the actual recording process. Every single transaction that occurs in a company has at least one account that is credited and one account that is debited. To record a sale that resulted in an accounts receivable, you would need to make a debit entry to the accounts receivable account for the sale amount and a credit entry to the revenue account for the same amount. Now, revenue is the amount of money that is received or will be received from a sale. By debiting the AR account and crediting the revenue account, the balances in both accounts increase. When payment is received on the account, the cash account is debited for the payment amount and the AR account is credited. This decreases the amount in the AR account and increases the cash account balance. Each time a payment is made on a customer account, it will decrease the AR balance, just as each time a new credit sale is made, it will increase the balance in the AR account. Now that I've given you the basics, let's look at an example. A couple of days ago, I had an unfortunate event occur. Lightning struck my television and completely destroyed it. Now, since I do like to watch TV, replacing it was a must. So I strolled right on down to the local electronics store, and I started to select my TV. There were TVs of all sizes and prices. At first, I only intended to purchase a 32-inch flat screen that cost $549. I knew I could pay cash for that. But then there it was, the TV of all TVs. I saw this 60-inch smart TV that could virtually read my mind and decide what channel I wanted to watch. That thing had more bells and whistles than I knew how to use, and a price that matched. But I didn't care. That was the TV for me. I didn't even think twice about signing my name on the dotted line of the store credit agreement and agreeing to the terms set forth in that agreement. In that one action, I created both a bill for myself and an accounts receivable for the store. The price of the 60-inch TV was $2,000. So how would journal entries look for this transaction? Since the electronics store sold me the TV and I purchased it, the entry would look like this. Accounts receivable would be debited for $2,000, and the sales revenue would be credited for $2,000. Now, the terms of the agreement are that I will pay $200 per month on the TV for 10 months. So what will the future journal entries look like as I make payments? Now remember, when recording a payment on an AR account, the cash account is debited for the payment amount, and the AR account is credited. That would mean that the journal entry would look like this. Cash would be debited $200. AR would be credited $200. Now this is the way that all the payments on the AR account are going to be recorded. The accounts receivable of a company, which are also called AR, are the money that is owed to the company by customers for goods sold or services rendered. In order for an AR account to be created, there must be a sale made by a company to a buyer that involves an extension of credit. If a sale is made or cash is received at the time of the sale, then no AR is created. Accounts receivable are considered assets of a company that are recorded in the accounting ledger and reported on the company's balance sheet. An asset is something that a company owns. The ledger is the place where all the increases and decreases in balance sheet accounts are recorded. And the balance sheet is the financial statement that reports all the accounts that a company has and their balances. When an AR is recorded in the accounting records, it is recorded as a debit to the accounts receivable account and a credit to a revenue account. Revenue is the amount of money that is received or will be received from a sale. This increases the balances in both the AR account and the revenue account. When a payment is made on an AR account, that payment is recorded as a debit entry to the cash account and a credit entry to the AR account, which reduces the balance in the AR account and increases the balance in the cash account. With each new AR transaction that occurs, the steps in the recording process are repeated. Have you ever been pulled over by the police? I experienced that for the first time the other day. I couldn't understand why. I knew I wasn't speeding or driving erratically. So why in the world was this policeman pulling me over? Well, it seems that I had a brake light out. Thankfully, I didn't get a ticket for that, but I could have. Unknowingly, I was breaking the law. Well, that made me start to think about laws in general. They're everywhere, including the world of accounting. Where the traffic laws are enforced by law enforcement, the laws of accounting are paroled by the Financial Accounting Standards Board. Part of the governance of the FASB falls to the Generally Accepted Accounting Principles, or GAAP for short. GAAP are the set of standards that enforce how accounting information is recorded and reported in the financial statements of a company. One of the concepts that's included in GAAP is revenue recognition. The textbook definition of revenue recognition is that it's the principle that states that revenue is recorded when it is realized or realizable and earned, not necessarily when it is received. So let's break down this definition of revenue recognition to learn a little bit more about it. The definition states that revenue is recorded when it is realized. Realized means that products or services have been exchanged for cash. It also says that revenue can be realizable and still be recognized. Realizable means that products or services have been exchanged, but payment was not received and is expected to be received on a later date. The final component of the definition says that revenue must be earned. Earned simply means that services have been performed or goods have been exchanged. Beyond that, there are a few more criteria that have to be checked off the list before revenue can be recognized and recorded. For starters, the manner in which revenue is generated must be considered complete or almost complete to count the revenue in the associated accounting period. Second, there must be a reasonable sense of assurance that the revenue earned is actually going to be received. The third criteria, in regards to revenue recognition, is in conjunction with another GAAP principle called the matching principle. This concept states that the costs that are associated with generating revenue must be reported in the same time period as the revenue. Let's look at an example. Bob builds fences. On the last day of June, he has almost finished constructing a nice privacy fence for Joe. The only thing he has left to do is to install a gate. The gate is scheduled to arrive from the supplier the next day. Bob gives Joe the invoice for the cost of constructing the fence and promises to install the gate as soon as it comes in. Joe won't be paying Bob until the next day when the job is 100% complete. Since it's the end of the accounting period and payment will not be received until the first day of the new accounting period, does Bob claim the revenue in this period or in the next? Bob counts the revenue in the current accounting period even though the payment has not been received yet. Why? Because the situation meets all criteria needed for revenue to be recognized and recorded. He has almost 100% completed the job. He's confident that payment will be received. The revenue is earned and realizable. It also meets the standards set by the matching principle, since the expenses that Bob incurred to erect the fence occurred in this accounting period, even though pay won't be received until the next period. As with anything, there are always exceptions to the rule. Revenue recognition is no different. There are three major exceptions to the revenue recognition principle. To start, revenue can be recognized for projects that are expected to take a long time to finish, but payment is received at different stages of completion. A good example of this would be large construction projects. Most companies that enter into contracts to build large buildings that are going to take more than a few months to erect make sure that their contract tells specific points in time where revenue will be received. It can be set as receiving payment once a month, at different percentages of completion, or whatever the company decides. When payment is received, it is recognized and recorded. A second exception to the rule applies to some manufacturing processes that count revenue after the process is complete, but before the sale of the product. An example of this one would be coal mining or natural gas pipelines. These companies know the value of their product as soon as it's collected, and that's the value they record for the natural resources. The last exception is pretty easy to digest. The manner of accounting that a person has decides how revenue is recorded. Revenue recognition only applies to the accrual basis of accounting. The accrual basis is the method of accounting that records revenue when it is earned and expenses when they are incurred regardless of when cash changes hands. The cash basis of accounting, which is the only other method that can be chosen, records revenue when it's earned and expenses when they're paid. If a business is using cash basis of accounting, then revenue recognition just doesn't apply. The set of standards that enforce how accounting information is recorded and reported in the financial statements are called GAAP. Revenue recognition is one of those concepts. The literal definition of revenue recognition is that it's the principle that states that revenue is recorded when it's realized or realizable and earned, not necessarily when it's received. Revenue that is realized means that products or services have been exchanged for cash. Realizable means that products or services have been exchanged, but payment was not received and is instead expected in the near future. Earned simply means that services have been performed or goods have been exchanged. There are three more criteria that must be met in order for revenue to be recognized. For one, the manner in which the revenue is generated must be complete or almost complete in order for the revenue it generates to be counted in the current accounting period. Next, there must be reasonable assurance that the revenue that is earned will be received. Third, the revenue must be recognized in the accounting period that expenses associated with earning the revenue occur. This is called the matching principle. But as with anything else, there are also exceptions to the rule. Some projects are so large that it takes months to years to finish. On these projects where payment is received at different stages of completion, the revenue is recognized when it's received regardless of when the project is completed. A second exception to the rule is for manufacturers who recognize the value of a product, such as coal or oil, when the manufacturing is complete, but before the product is sold. The last exception to the rule is based on the accounting method that a company uses. Revenue recognition only applies if a company uses the accrual basis of accounting, where revenue is recorded when it is earned and expenses when they are incurred, regardless of when cash changes hands. Companies that use the cash basis of accounting, where revenue is recognized when it's received and expenses when they are paid, are exempt from the revenue recognition principle.
Customers can pay with two different types of credit. One is a credit account with the store itself, which will create an account receivable for the store. The other is with a major credit card, MasterCard, Visa, where a bank will pay the store and the customer will pay the bank. That does not create an account receivable for the store since they have already been paid. Imagine that you're a business owner. In your store, you have two ways to pay for merchandise. A customer can pay cash, or he or she may open a credit account and make monthly payments to you until the merchandise is paid for. Do you think that every single person that you extend credit to is going to pay their accounts in full and fulfill their credit agreement? Unfortunately, not every customer will do that. There are a few that will leave you hanging. This type of customer account falls into a category known as uncollectible accounts. Uncollectible accounts are accounts that can't be collected because of the inability of a customer to pay the account or the lack of interest in paying the account. Just as with any other type of account, uncollectible accounts must be recorded in order to ensure accurate financial reports at the end of an accounting period. How exactly are uncollectible accounts accounted for? The most common way, and the way that we will focus on in this lesson, is by using a combination of two accounts, the allowance for doubtful accounts and the bad debt expense. I'm going to discuss the allowance for doubtful accounts first. The allowance for doubtful accounts is an offset of the accounts receivable account and is used to reduce the balance in the accounts receivable of a company. But what is the accounts receivable of a company? The accounts receivable is the account that is used to record credit sales or money owed to a company. Each time that a credit sale is made, the balance in the account receivable account increases. The balance represents the amount of money that the company expects to receive from its credit customers. When a customer doesn't pay, then obviously the balance in that customer account will not be collected. Here is where the allowance method comes into play. Since the business owner doesn't know who will or will not pay, then they must estimate a reasonable dollar amount that won't be collected in order to keep their accounting records as accurate as possible. If the company has been in operation for a little while, then they can reasonably decide the percentage of past accounts that were uncollectible. If not, then the rule of thumb is to use the industry average to calculate what dollar amount of uncollectible accounts can be reasonably estimated for each accounting period. Keep in mind, however, that the dollar amount calculated is simply an estimate of a future bad debt. For example, let's say that the business you own is a children's clothing store. This is your first year of operation, so you really don't know how many of your credit customers will actually pay you or not. The industry average of uncollectible accounts in the children's clothing industry is 1.5%. The total amount of credit sales that you had for the second quarter was $11,200. Of those sales, according to the industry average, you believe that 1.5% will become uncollectible. That gives you a total dollar amount of expected uncollectible accounts of $168. Now, let's say that you've been open for 3 years, and you know that historically your percentage of uncollectible credit sales is 0.89%. If the credit sales for the current period are $14,128, then the amount of these credit sales that are considered uncollectible is $125.74. Now that you know how to calculate the dollar amount of expected uncollectible accounts using the allowance method, let's talk about how this amount is recorded in the accounting records. Any transaction that is recorded in the accounting records of a company requires the use of two accounts. One is debited and one is credited. We already know one account that is used to record information about uncollectible accounts. It's the allowance for doubtful accounts. The account that is used in partnership with the allowance for doubtful accounts is called the bad debt expense account. The bad debt expense account is the account that shows the amount of uncollectible accounts receivable that have occurred in a given accounting period. Why is an expense account used? Because funds that are expected to be collected but end up as uncollectible become expenses to the company. Let's look at how the first example we talked about earlier is recorded in your accounting records. The first example is calculated using a percentage that is based on industry average. In that example, we calculated the expected amount of uncollectible accounts in the second quarter of year 1 of operation based on the allowance method to be $168. To record this, you debit the bad debt expense in the amount of $168 and credit the allowance for doubtful accounts in the same amount. That entry would look like this: June 30th, bad debt expense $168. Allowance for doubtful accounts $168. How do you think the second example will be recorded? If your answer is to debit the bad debt expense account in the amount of $125.74 and credit the allowance for doubtful accounts account in the same amount, then you're exactly correct. You've now entered an estimated value for future bad debts. The reason that you record the estimated amount of bad debt that you project will occur in the future now is so that you can match the proposed bad debt with the sales that you expect will generate that bad debt. Doing so follows one of the guiding principles in financial reporting, the matching principle. The matching principle states that expenses should be recorded in the same time period as the revenue that generated the expenses was earned. This helps give a better idea of what profits from sales really are. A business owner never extends credit to a customer with the expectation of not receiving payment. However, the reality is that there are times when that happens. Accounts that can't be collected because of the inability of a customer to pay the account or the lack of interest in paying the account are called uncollectible accounts. In order for accounting records to be as accurate as they can possibly be, these accounts must be accounted for. The most common way to account for uncollectible accounts is by using the allowance for doubtful accounts, which is an offset of the accounts receivable account used to reduce the balance in the accounts receivable of a company, and the bad debt expense account, which shows the amount of uncollectible accounts receivable that have occurred in a given accounting period. To calculate the amount of uncollectible accounts, new businesses should base the number on an industry average percent, and established businesses should use the past history of uncollectible accounts. That percent is then multiplied by the total credit sales for the given time period to get the allowance amount. The bad debt expense account is debited for the amount of the allowance, and the allowance for doubtful accounts is credited in the same amount. Making this entry reduces the balance in the accounts receivable account and fulfills the requirements of the matching principle that states expenses should be recorded in the same time period as the revenue that generated the expenses was earned. Once these transactions are recorded, then the forecasted uncollectible accounts are accounted for.
Have you ever heard the phrase, "it takes money to make money"? While not exactly motivation for any penniless entrepreneurs out there, it does make sense. Companies rarely start out of nowhere. Even apps, which exist only online and on our phones, require fixed costs of coding, equipment, and even servers. With all those costs of starting even a traditional business, you'd think that people could just buy now and pay later. After all, that's what credit cards do, right? And let's face it, if I don't have to pay now, maybe I will feel comfortable spending a bit more. To this end, many firms offer their customers the ability to take advantage of goods and services now but pay further on down the road. The term for keeping track of what customers buy on credit from a company is called receivables management. As we'll see in this lesson, it takes a special role in many modern businesses. Companies, like I said, like to offer the ability for their clients to pay later, knowing that this will help maintain loyalty and increase the amount that they can buy at a given time. Sometimes you'll see it flatly referred to as buying on credit. So what should you do with that information? Simply put, you file it as a receivable because you will receive the payment in the future. Keeping track of all these different receivable accounts is an important task because if it is ignored, you could leave clients unbilled. Worse, you may not bill them on time, leading them to believe that you are not organized. Receivable management departments keep track of all these different accounts, making sure that they are eventually paid. There are a number of reasons that it is important to make sure that you have a properly functioning receivables management capability in your company. Notice that it doesn't have to be an entire department, even though larger firms will certainly have numerous groups. First of all, like I said earlier, it helps you keep track of who owes you money and for how long it has been owed. The different accounts that fall under receivables management are like checks. They are only good for your bottom line if they are cleared and end up in your company's account. However, there are other reasons too. You may find it advantageous to extend larger lines of credit with your firm to those companies that use your goods or services the most. Good receivables management lets you quickly know which firms deserve the extra level of trust. Likewise, you may find that some companies have been continually late in paying their bills, and therefore should have their line of credit decreased or even revoked. Of course, this could cause some tensions with the company in question, but should be a part of the final decision. Let's take a look at a receivable management system in action by looking at a very common form of business, a restaurant. You've just started a restaurant and try to convince your food supplier to give you a line of credit so that you can pay for your food after you sell it. Usually, suppliers are hesitant to extend such lines, but you have a proven record with another food service company, so the manager gives you a line of credit. You purchase $15,000 in food at the beginning of the month. You are able to cook that food and make $60,000 gross earnings, which means that you can easily repay the $15,000 at the end of the month. However, let's say you didn't make $60,000 gross. Let's say you only made $20,000. In that case, you probably can't repay the debt. As such, your supplier refuses to sell you food on credit anymore. You now have to pay cash for each purchase. As a result, your business's cash flow problem is now even more acute. Simply put, the moral of the story is to keep those suppliers who use receivables management happy. In this lesson, we looked at the use of receivables management, or the ability to keep track of what customers buy on credit from a company. We saw why it was to the advantage of companies to offer such lines of credit, because it means that customers will often stay loyal and buy more. However, we also saw why companies have to take special care to manage these accounts, because firms can go without being billed. After all, accounts receivable are more of a list of IOUs than anything else. As the owner of a widget company that is known for the high quality of its products, you may not think that warranty and service costs are really something that you should waste your time on. After all, wouldn't it be better for you to focus on making your widgets as high quality as possible in the first place, rather than looking at all those that fell short? Unfortunately, that doesn't work. Successful companies should always have a strategy for dealing with faulty products, and that extends to the accounting department. In this lesson, we'll focus on how to calculate warranty and service costs for an object and how it functions in accounting books. By warranty and service costs, I mean those costs incurred by a company as a result of honoring warranties or providing corrective services to a product. Before we can do anything, we've got to figure out what our historic warranty expense percentage is, or the amount of money that is historically spent on repair or replace goods that have been returned. For a product that has been in circulation for a while, that's easy enough. Just look at the percentage of returns and you'll have your number. Otherwise, it's best to use an estimate. However, like everything else on a planning budget, it is important to bear in mind that this is only an educated guess. You'll find that while you have a good in production, chances are that this number will fluctuate wildly. Don't take it personally. Just continually focus on keeping those widgets high quality and making sure that your budget has room in it to absorb the cost of replacing or repairing those widgets. Now, the fun part. Assigning the expenses to accounts. First things first. Multiply your historic warranty expense percentage by the total number of sales you had off that good. That gives you the historic warranty expense, or how much you can expect to spend on warranty and service-related costs for that product's batch. Here's what's important. You're going to record that amount as a debit, or cost, to the warranty expense account. After all, it is a cost of having a warranty. Also, you'll record the same amount as a credit to the warranty liability account. That gives you the money on the books to draw the expenses from when and if a good has to be replaced. So what do you do when a good comes in that needs to be replaced? You debit the cost of the expenses associated with the replacement to the warranty liability account, which is the one you put the extra money into. That has to be balanced out, so you put the same amount as a credit to the account from which the fix came to acknowledge the fact that they did work or provided inventory. Okay, obviously that's a lot to play with, so let's look at another example. Your new line of widgets just sold $10 million worth in a matter of a few weeks. Using your historical rate of 1% of widgets requiring some warranty or service attention during their useful lifetimes, that means you have a historic warranty expense of $100,000. You'll debit that much from the warranty expense account while adding that much to the warranty liability account. Now someone comes in with a broken widget demanding a refund. They paid $500 for their failed widget. As such, you give them a new widget, deducting $500 from the warranty liability account. That leaves the account with $99,500 for future issues without impacting the bottom line of your budget. Meanwhile, you credit $500 to the inventory, since you took a new widget out of inventory to replace the old one. Let's review. In this lesson, we looked at a way to calculate warranty and service costs, those costs incurred by a company as a result of honoring warranties or providing corrective services to a product. When offering goods or services with a warranty, it is important to make sure that it is accounted for. To do this, you need the historic warranty expense percentage, or amount of money that is historically spent to repair or replace goods that have been returned. From there, you'll multiply that rate by the total sales of the widget in question to find the historic warranty expense, or how much you can expect to spend on warranty and service-related costs for that product's batch. With that information in hand, you can deduct the historic warranty expense from the warranty expense account while adding it to the warranty liability account. It is from the warranty liability account that claims against warranties and service will be made, which in turn reimburse inventory for the loss of the new unit.
Have you ever borrowed money from a bank? What about purchasing a car? For that matter, have you ever signed any paperwork where you agreed to pay a specific sum of money to someone by a specified date? If so, then you've taken part in creating a note receivable. A note receivable is a formal promise in writing to pay a specific amount of money on a specified date or dates made between a borrower, the one who borrows money, and a lender, the one who lends money. The written agreement that is signed between the borrower and lender is called a promissory note. There are several key items that need to appear on a promissory note. They are the date the note begins, the length of time the note extends for, the name of the borrower, the amount of money borrowed, the interest rate, the maturity date, and the name of the lender. For this lesson, we're going to focus on two of those components, the maturity date and the interest rate. The maturity date of a note is the date that the loan is due and payment must be received. But how is this date calculated? Well, it all depends on the wording on the promissory note as to how a maturity date is calculated. If the note states that the term of the loan is in months, then the maturity date is calculated in months. For example, let's say that I go to the bank on June 20th and borrow $1,000 on a 3-month loan. In this case, the calculation of the maturity date is simple. You would just count 3 months from the date the note begins, which would be September 20th. Now, what if the loan is a 90-day loan? Since 90 days is 3 months, then the due date would be the same, right? Wrong. When the number of days are used in the context of a promissory note, then each and every day is counted. In this instance, to figure the maturity date, I start counting beginning with the day after the note begins, which would be June 21st. My calculation would look like this. As you can see from the example, the maturity date of the 90-day note is September 18th. By counting days instead of months, there's a 2-day difference in the maturity date. The next part of a note receivable that we need to look at is interest. Interest is the amount of money charged to the borrower by the lender for making a loan. Interest can be classified as simple or compound. Simple interest is interest charged just on the original amount of the loan. The formula for calculating simple interest is interest equals PRT. P stands for principal, which is the dollar amount borrowed. R stands for rate, which is the percentage charged on the dollar amount borrowed. T stands for time, which is the length of time between the date the note was signed and the maturity date. The time portion of the calculation can be expressed in days, months, or years. Compound interest is interest that is charged on both the principal amount of a loan and any accrued interest that is accumulated. For the purpose of this lesson, we're only going to look at simple interest calculations. I went to the bank and borrowed $1,000 on a 1-year note at an interest rate of 9%. I equals PRT. I equals 1,000 times 0.09 times 1. I equals 90. So the amount charged for interest on this loan would be $90. So my balance due on the note would be $1,090. If I change the time on the same loan to 6 months, what would the interest be? In this case, my time will be expressed by a fraction since the note duration is less than a year. Since there are 12 months in a year, the denominator for the fraction is 12, and the numerator is the time period of the note. In this case, the time would be expressed as 6 over 12. The calculation would look like this. I equals PRT. I equals 1,000 times 0.09 times 6 divided by 12. I equals 1,000 times 0.09 times 0.5. I equals $45. For a 6-month time period, the interest on the loan would be $45, and the total balance due on the note would be $1,045. What would the interest be if the time on the same loan was changed to 90 days? Once again, the time would have to be expressed as a fraction. In many cases, the calculation is made based on a banker's year, which is the 360-day year that is used by the majority of banks and other lending sources for simplicity in the calculation of interest. The government, however, and some other lenders base their calculations on the 365-day year. For this lesson, we'll use the banker's year. The calculation of interest would be as follows. I equals PRT. I equals 1,000 times 0.09 times 90 divided by 360. I equals 1,000 times 0.09 times 0.25. I equals $22.50. For this time period, the interest charged will be $22.50, and the total amount due on the note would be $1,022.50. A note receivable is a formal promise in writing to pay a specific amount of money on a specified date or dates made between a borrower, the one who borrows money, and a lender, the one who lends money. The written agreement that is signed between the borrower and the lender is called a promissory note. Two very important pieces of information found on a promissory note are the maturity date of the note and the interest rate applied to the note. The maturity date of a note is the date that the loan is due and payment must be received. It depends on the wording of the promissory note as to how the maturity date is calculated. If it states that the term of the note is in months, then the maturity date is simply counted on months. If the term of the note is in days, then each day beginning with the first day after the note is signed is counted. Interest is the amount of money charged to the borrower by the lender for making a loan. It can be classified as simple interest, which is interest charged just on the original amount of the loan, or compound interest, which is interest that is charged on both the principal amount of a loan and any accrued interest that is accumulated. In this lesson, we calculated interest by using the simple interest formula I equals PRT. We also use the banker's year, which is a 360-day year that is used by the majority of banks and other lending sources for simplicity.
Meet Lynn. She owns a small manufacturing company that makes organic canned soups. Lynn has a problem. An important machine in her factory has broken beyond repair, and she needs to replace it immediately, or she will lose a ton of money on food spoilage and orders she can't fill. Making matters worse, she doesn't have the cash on hand to pay $300,000 to replace the machinery. What's even more frustrating to Lynn is the $400,000 in receivables sitting on her books that aren't payable yet. A receivable is money that a business or person is owed for delivery of a good or service, but has not yet been paid. Lynn doesn't require immediate payment from her largest and most important customers. Instead, payment is due within 60 days of delivery. This is when the receivables reach maturity and are due for payment. Consequently, Lynn won't get paid on most of these receivables for about another 2 months, and that's assuming that our customers make their payments on time, which doesn't always happen. Nevertheless, Lynn still has a couple of options that may allow her to convert the receivables into cash immediately. Let's take a quick look at how she can do it. Lynn can sell her receivables to a third party at a discount. This type of transaction is known as factoring, and the third party is known as a factor. The price a factor will pay for the receivables will depend upon how far out the maturity date is and how easy it will be to collect the payments. Consequently, Lynn will probably have to let the prospective factor audit her receivables account to determine how collectible the receivables are. Lynn will have to give a deeper discount, i.e. accept a lower price, if a significant amount of the receivables relate to customers who are slow to pay or in default. In other words, the harder it is to collect the debt, i.e. get paid, the less money the factor will be willing to pay because the factoring company makes its money from the difference between the price it pays for the receivables and the amount it actually collects. Receivables have economic value even if they can't be converted immediately to cash. Consequently, they can serve as collateral for a loan. For example, Lynn can go to her regular commercial banker and offer her receivables as collateral to secure a loan to buy the equipment she needs. If she defaults on the loan, the bank will have the right to the money collected when the receivables come due. Offering an asset to a lender to secure a loan is called pledging. Let's review what we've learned. A receivable is money owed as payment for delivery of a good or service that is yet to be paid. Receivables can be converted to cash through factoring or pledging. Factoring involves selling receivables to a third party, a factor, at a discount. The harder it is to collect the receivables, the lower the price a factor will pay for them. Pledging involves offering the receivables as collateral for a loan. If you default on the loan, the bank will have a right to receive the